Every year, we all make a resolution to manage our finances more responsibly. However, there are several financial traps in the marketplace which seem free, easy, and helpful on the surface, but are often a recipe for disaster. Avoiding these schemes may be the first step to financial freedom. Today, we're counting down the top 5 financial traps in Black America. You are watching Black Belief. Be sure to like, subscribe, and hit that notification bell so that you never miss a new video. Rent to own. Rent-to-own companies, which are also called rental purchase companies, allow customers to lease products on a weekly, bi-weekly, or monthly basis while they are using it. Instead of requiring a credit check, the customer pays a fee in addition to their recurring payment. If customers decide they no longer want to continue to lease, they can return their item for no additional cost. They can also pay off the remaining balance of the lease if they wish to own the item earlier. Companies will also often include free installation and repair in the lease agreement. Most rent-to-own companies offer brick-and-mortar storefronts where customers can visit to view available merchandise. Critics of rent-to-own agreements point out that a person who makes their recurring payments on time and finishes the entire term of their lease will have paid 2 or 3 times more for an item than if they had purchased it outright. These excessive payments, they say, far exceed the cost that companies incur by offering installation and repair. Many of the items leased have been returned by previous customers and are even lower in value when they are released to others. In short, consumer advocates believe that the rent-to-own industry is really a form of predatory credit disguised as a lease. The industry responds by saying that the higher cost of the items is due to the servicing of merchandise, the option to return the item, and the increased risk of leasing to customers with lower credit scores. They also point to data which shows that most items are returned in 4 to 6 months, meaning that customers are only looking for a short-term use option. This industry data is difficult to verify, and there are other studies showing that most leases are eventually finished and the item is purchased. There is also evidence that most customers originally intend to fully purchase the item. But industry advocates also point out that though they don't claim to be in the business of offering credit, they will sometimes report to credit agencies. This provides an opportunity for customers to increase their credit scores by making on-time payments. But these supposed credit benefits do not outweigh the risks. Businesses which offer credit are subject to the Truth in Lending Act, or TILA, which requires written disclosure of the annual percentage rate and terms of the credit arrangement. Another piece of legislation called the Consumer Leasing Act, or CLA, requires disclosures related to leases that are longer than 4 months. Because rent-to-own companies call their product a lease, and the customer has the option to end their agreement at any time before the 4-month mark, the rent-to-own companies have avoided these federal regulations. State regulations vary. Rent-to-own companies are also not subject to the Fair Debt Collection Practices Act, because this act only applies to third-party collectors. Reports of abusive collection practices have surfaced, including threats or even breaking into customers' homes. Yet another objection to these leases is the possibility of late-term repossessions. A customer doesn't fully own an item until the last payment is made. If they fall behind, the rent-to-own business may repossess the item with no obligation to return any of the previous money paid. If the business reports to credit agencies, the repossession could actually decrease the customer's credit score. The industry targets those who cannot access credit from mainstream lenders, cannot afford the full purchase of an item in cash, and cannot or will not wait to save cash. Thankfully, rent-to-own companies are facing decreased profits as other forms of flexible leasing for consumer products have become more popular. Buy now, pay later. During the pandemic, a new finance product which builds upon the rental purchase model surged in popularity. It's called Buy Now, Pay Later, or BNPL. BNPL is a form of short-term credit which customers leverage at the point of sale. When a customer is ready to check out in a participating store, either in person or online, they will see an option to split the payment into multiple installments. Unlike a credit card, most BNPL companies do not charge interest for this arrangement. Instead, the customer makes a small down payment and then pays equal recurring payments over a fixed time frame until the purchase is paid off. In order to remain competitive, credit card companies are also starting to offer their own BNPL services for their customers. However, BNPL companies have other advantages over credit cards. When screening customers, these companies typically do a soft pull on a person's credit. Credit card applications, meanwhile, require a hard pull, which often results in a small decrease in a credit score. BNPL companies also evaluate your history on their platform to allow you to split increasingly higher amounts into payments. The process of approving customers is common throughout the financing industry and is called underwriting. With BNPL, customers encounter fees and credit score risk only if they miss a payment. Credit cards, however, will always charge interest if a balance is carried over into the next billing period, even if a minimum payment is made. BNPL can be used to pay for clothes, travel, event tickets, and more. Anything that can be financed with a credit card can be paid for with BNPL, subject to the platform's approval. Two big players in this industry are Klarna and Affirm. Klarna was founded in Sweden in 2005. It partners with retailers to offer the option to split a purchase into 4 payments, pay in full in 30 days, pay in full at the point of sale, or extend financing from 6 months up to 24 months with an added interest rate. The pay in 4 option requires a minimum of a 25% down payment, a percentage which may be higher based on Klarna's underwriting for a customer. Klarna partners with thousands of retailers so that loyal customers can easily check out with Klarna payment options in person or online. At non-partnered retailers, customers can still use Klarna for an additional fee. Affirm was founded in 2012 in the United States by a co-founder of PayPal. Unlike Klarna, Affirm allows more customization of the payment schedule. Customers may select to split their payments into 3, 6, or 12 payments. Affirm also allows merchants to select the minimum and maximum purchase price allowed in their stores through the platform. Another difference with Affirm is that while many customers will qualify for a 0% interest rate on their payment plan, some may be required to pay a 10% or 30% annual percentage rate based on the app's underwriting. If a payment is missed, some companies will charge late fees. If they are unable to collect payment, they will send the debt to a third-party collection company, which will negatively affect a customer's credit score. BNPL companies promote themselves as a better alternative to credit cards. They point out that the bulk of their revenue comes from charging merchants to partner with them rather than from late fees. However, consumer advocates warn that these companies are most often used by consumers with incomes between $20,000 and $50,000. These consumers are more likely to use predatory financial products. They are also more likely to have other delinquent credit lines and lower credit scores. Because competing BNPL companies do not have insight into each other's customer profiles, a customer can have several active payment plans across different platforms, a process called stacking. Customers with more than 4 simultaneous loans are twice as likely to miss a payment as those with fewer loans. BNPL companies are also not a credit building tool. Neither Klarna or Affirm report on-time payments to credit bureaus unless you select a longer-term loan option. But loans sent to collection will result in credit damage. The BNPL industry, just like the rental purchase industry, is largely unregulated because of the nature of its financing model. This may leave customers with less information and protections than they would have with other finance products. The use of buy now, pay later shows no signs of decreasing. During the week after Thanksgiving in 2022, BNPL loans increased by 85%. Increased consumption of unnecessary goods is now easier than ever. Multilevel marketing. In a pyramid scheme, people are recruited and asked to pay a fee, which pays out an earlier recruit. The new recruits bring in others in order to receive a payment themselves. There is no product, service, or investment involved in these arrangements. People are paid money after they recruit a certain number of people. Because of the focus on recruitment, a pyramid scheme will fail quickly. In a hypothetical scheme where participants are asked to recruit 6 people each, the pyramid will collapse after just 11 rounds of recruitment because the amount of new people needed to sustain the pyramid will exceed the total population of the United States. At the 13th round of recruiting, the total number of new people needed exceeds the entire population of the world. The only people who receive profit from a pyramid scheme are those at the top of the pyramid. The scheme itself will always fail to deliver payouts for later recruits. For these reasons, pyramid schemes are illegal in the United States. But what about another business model where people can recruit others to sell products or services and make commissions from the recruit's sales? This other model is called network marketing, multi-level marketing, or just MLM. MLMs claim that they have a great product or service, but they choose to sell it to consumers via a network of distributors or partners who work as independent contractors. In order for an MLM to be legal, it must sell 70% of its products to non-distributors. Potential participants are often invited to a presentation where they are told about a flexible, low-stress business opportunity. They are told that they can sell products or services part-time from home. They are also shown testimonials of others who allegedly quit their 9-to-5 jobs to sell the MLM's products full-time. They may hear emotional speeches about current participants' religion, immigration status, or ethnic background. Lastly, they are told that if they choose, they can participate in the so-called team building opportunity. This allows them to sell the product themselves while also earning money from the sales of the new distributors that they recruit. As new recruits participate in recruitment themselves, the original participant can earn commissions on sales occurring at several levels of their so-called downline. Once a person joins the MLM, the truth about the business model becomes clear. Distributors may be required to purchase inventory, a sales kit, a distributor course, or some other item to get started. They may be required to pay a monthly subscription fee to the MLM's platform to remain an active distributor. They will be required to join conference calls several times a week, where they will be coached by their mentor, the person who recruited them, on how to host a demonstration party or make cold calls in order to sell products and recruit others. Distributors soon realize that the products or services they're trying to sell are sold at storefront or e-commerce retailers for a fraction of the price. These alternatives are of equal or better quality and are also more readily available. There is no organic consumer demand for their MLM product. After exhausting their network of friends and family for sales, distributors notice that the only way to recoup the money and time they've spent is to recruit others. They will earn more money by maintaining a large team of recruited members beneath them, even if those newer recruits struggle to make sales themselves. What was first presented as a passive income earning opportunity suddenly becomes another full-time job.
The fundamental flaw in MLM is the endless chain of recruitment of participants as primary customers. MLM pay plans assume infinite markets and virgin markets, neither of which exists in the real world.
Distributors are told at weekly team meetings to continue in the MLM at any cost. Many max out credit cards or mortgage homes in order to continue to buy inventory or make monthly MLM payments. Recruits are encouraged to stop contact with anyone who speaks negatively about the MLM. They are told that individual effort is the difference between those who succeed and those who fail. The data, however, tells a different story.
Based on my analysis of all the multi-level marketing companies in my research, at best only 1 in 1,000 achieve a level at or near the top of the pyramid of participants where they could report a significant profit, more than a minimum wage, on their income taxes, and far less earn the amounts of money that are thrown out to prospects at opportunity meetings as possible to attain. Of course, they protect themselves by saying there are no guarantees the new recruits will earn that much. They would be much more honest saying that it is virtually guaranteed that they will not earn those huge paychecks, but will in fact lose money.
In his report, Dr. Taylor found that the odds of winning a game of roulette in Las Vegas was higher than that of profiting from an MLM. MLMs are actually worse than pyramid schemes. While pyramid schemes collapse quickly, with some hope of funds being recovered from those at the top, MLMs keep people involved for years before they realize they have not made a profit. Because these businesses are legal, distributors will never recover the majority of what they've spent. MLMs play a game of misdirection with their victims. The corporate-sounding language, inspirational pep talks, and glamorous testimonials are a distraction from the fact that no one except for those at the very top are making any money. Contract for deed. When Tiffany Martino moved to North Platte, Nebraska in 2015, her first priority was buying a home. She found a place listed for $78,000, but the house was in disrepair. It needed a paint job, a new floor in one of its rooms, and extensive bathroom repairs. The owner of the house was willing to accept a $1,400 down payment and monthly payments of $500 until the rest of the house was paid off. Martino would also be responsible for paying to fix up the home. At the time, Martino wasn't eligible for a traditional mortgage and couldn't afford a large down payment. It wasn't the best deal, but she agreed. Over the next 5 years, she invested over $10,000 in property improvements and paid about $30,000 in rent payments. But at some point, she fell behind. When she accumulated $3,000 in arrears, the homeowner sued to have her evicted. Jeff Eastman, the managing attorney for Legal Aid of Nebraska, told Tiffany the bad news. If she went to court, the judge could order her to pay the owner and she would still be evicted. He suggested that she try to settle out of court. So she did. In exchange for leaving the home, the owner agreed to forgive her $3,000 debt. She didn't receive any reimbursement of the $10,000 she invested in the home or any of the $30,000 she paid in rent. Despite years of on-time payments, she had no equity in the home. She thought she was on the path to home ownership, but in the end, she was left at square one. Tiffany's story is one of many who have entered into a legal arrangement called contract for deed. The agreements are known by many names like land contracts, lease contracts, bond for deed, bond for title, agreement for deed, and poor man's mortgage. Their use emerged in the post-World War II era to target aspiring homeowners who did not have access to traditional financing. In 1934, the Federal Housing Administration, or FHA, was established to facilitate the building and financing of family housing. Construction declined during the Great Depression, and there were many families who were in need of affordable lodging. When deciding where they would finance construction, the agency drew maps of metropolitan areas. Based on the belief that the mere presence of African Americans would decrease home values, the agency color-coded areas that had a high population of Black residents red to indicate these areas were unsafe for investors. This process became known as redlining. Contrary to fears about Black home ownership, property values would often rise when African Americans moved to majority white areas because African Americans were willing to pay above the market rate for a property due to their limited housing options. Nevertheless, the FHA refused to insure mortgages in red areas. These color-coded maps were adopted by other agencies like the Veterans Administration and prevented Black families from securing mortgages in Black neighborhoods. It also limited commercial investments in these areas. The FHA also built racially segregated public housing for working class and middle class families. At first, these developments were not meant to serve poor people. At the same time, developers like William Levitt created planned communities like Levittown in Long Island, New York, for middle-class families and veterans. The FHA subsidized the development of these communities on the condition that they were restricted to white families only. The federal funding for these planned communities incentivized white families to leave all-white public housing buildings, resulting in a large number of vacancies. Meanwhile, Black public housing communities had long waiting lists. Eventually, the federal government allowed Black residents to move into white public housing, but that only accelerated white relocation to the suburbs. Soon the population of public housing was majority Black, and this housing became subsidized. The result was that instead of public housing attracting middle-class Black families, it slowly transitioned to attracting low-income Black families. When Black middle-class families tried to move to the suburbs, developers and real estate associations refused to sell homes to them. Cities introduced restrictive covenants, which made it illegal for a homeowner to sell their home to any person who was not a member of the so-called Caucasian race. Terms like restricted and protected were euphemisms for communities that excluded non-white residents. Homeowners associations would sue homeowners who sold their property to non-white buyers. It was this environment that set the stage for contract for deed agreements. The scheme started with a practice called block busting. Real estate agents would hire a Black woman to walk with a stroller or hire two Black men to fight on a sidewalk in an all-white neighborhood. Agents would then go to white homeowners and capitalize on their fears of so-called neighborhood change. The agents would convince white homeowners to sell their homes at below market rates so that the homeowners could flee before supposedly losing all of their home's value. After buying the properties cheaply, the real estate agents would rent the properties to Black residents at above market rates. Some residents who wanted to eventually own their homes signed contract for deed agreements. These contracts required a down payment and monthly installments to pay for the cost of the home. The resident was responsible for all home repairs, taxes, and required insurance. However, the homeowner maintained possession of the deed until the final payment was made. Contract for deed is a rental purchase agreement for housing. The resident has all of the responsibilities of home ownership and renting without any of the protections. The resident does not build equity in the home while they are making payments. They are not entitled to a home inspection before signing an agreement. They can be evicted after missing just one payment or for other minor offenses. The amount of the payment is determined solely by the seller and will often be far above the fair market price of the home. In the mid-20th century, 85% of Black homes in Chicago were under contract for deed agreements. In the 1960s, a Jesuit named John McNamara performed a title search for properties in a Chicago neighborhood and confirmed what he and the residents already knew. Black residents in contract for deed agreements were paying an average of $20,000 more for homes than their white counterparts. Eventually, he and other residents formed an organization called the Contract Buyers League, which used several tactics like protesting, stopping payments, and filing class action lawsuits against the contract companies. The Contract Buyers League was ultimately successful in renegotiating 450 contracts, which saved families an average of $13,500. Even today, some claim that this arrangement is a way to help low-income people purchase homes. But the data shows that these agreements are designed to fail. Most residents do not ever receive the deed and are evicted due to late payments or other reasons. Contract for deed agreements increase during times of economic decline when lending requirements become more stringent. After the 2008 recession, the number of registered contracts shot up quickly, especially in Midwestern towns. Other scams have also sprung up around these contracts. Sometimes a seller will enter into a contract and disappear right after the last payment is made, never handing over the deed. Other times people will enter into contracts for houses they do not own. It's not until the resident is evicted or tries to secure the deed that they discover the truth. Contract for deed agreements combine all of the worst elements of predatory lending to exploit people's belief in the American dream. Before we go over our last financial trap, let's talk about some honorable mentions. Title loans. A title loan is a loan which uses a person's car as collateral. Title loan companies typically don't perform credit checks and will lend up to 25% of a car's value. These loans are attractive to people who own their cars outright and need cash quickly. However, the annual percentage rate for the title loans is almost always above 100% and can be as high as 300%. There is also the danger of defaulting and the title loan company repossessing the borrower's car. Without a vehicle, the borrower may be unable to get to work and therefore be even less likely to be able to pay for expenses and pay off debts. Layaway. A layaway purchasing option allows a customer to pay a deposit on an item and pay the rest of the cost over time. During the payment period, the business selling the item keeps it on their premises. Companies do not perform a credit check for layaway. If a layaway contract is canceled, a fee, often about $20, is charged. After cancellation, payments which have already been made, minus service and cancellation fees, are returned to the customer. Due to the rise of buy now, pay later platforms, the availability of layaway has declined. Companies bear most of the cost to operate layaway plans, since they must keep the inventory until it is paid off or try to sell it at a loss if layaway plans are canceled. Companies like Big Lots, Army and Air Force Exchange, and Marshalls still offer layaway. Walmart, one of the biggest companies to ever offer layaway, replaced its program by offering customers the option to pay with Affirm. The downside to layaway for consumers is that the items they are paying for decline in value over time. An item would most certainly be cheaper on the sales floor by the time a customer pays it off on layaway, unless they pay it off quickly. Layaway fees are an additional unnecessary cost for items like clothes, which are relatively low value. Customers are also not able to build their credit history with layaway. Still, out of all installment plan options for consumer items, layaway is the least expensive, least risky, and least exploitative for the customer. And now, our final financial trap: payday loans. Payday loans are small, short-term loans which must be paid within 2 to 4 weeks. Most payday loan companies avoid discussing the annual percentage rate of their loans and instead attract customers by promoting their quick lending processes that require no credit check. While the typical credit card APR is 15 to 30%, the APR for payday loans can range from 35% to 600%. In practice, most of these companies will only operate in situations where they can legally charge a minimum of 200% APR. Payday loan companies target the unbanked, the undereducated, and the desperate. People who make low incomes and do not have access to short-term credit options are particularly vulnerable. The companies depend on trapping borrowers in a cycle of rollovers, which cost thousands of dollars in fees, but leave the original loan balance unpaid. Some companies will place limits on how many times you can roll over your loan. Once you have exhausted your rollovers, you will be forced to pay the full loan amount. In these cases, borrowers become so desperate that they resort to taking out payday loans from other companies to pay off the payday loan which is due. 18 states and Washington, D.C. have outlawed payday lending completely or driven the industry away by placing a cap on how much interest can be charged on loans. Other states attempt to regulate the industry more carefully. There are several states where there are no regulations and no protections. In Texas, lenders can charge up to 664% APR to borrowers. The industry used to heavily target armed service members until the Military Lending Act was passed in 2006, which capped the interest rate for active duty service members, including those active in the National Guard or the Reserves, to 36%. This legislative action led many payday lenders to simply refuse to offer their loans to active duty service members completely, rather than take lower profits by adhering to the Military Lending Act maximums. On Native American reservations, the situation is often worse. Because these areas operate under the sovereign immunity of tribal leaders, the companies on tribal land are able to ignore state-level interest rate caps. Indigenous borrowers may pay from 300% to 800% APR and might not be covered by any protections at the state level. Payday lenders claim that they are simply offering a service to people that banks and other mainstream financial institutions refuse to serve. They claim that the consequences for their borrowers would be worse if they were not available to provide a loan. Several statistics cast doubts on their claims. More than half of all borrowers who get payday loans from an online lender default on these loans. 80% of borrowers roll over or reborrow payday loans within 30 days. Payday loan companies also don't report to credit agencies, so successful payment of loans and fees does not help a borrower improve their credit. When a borrower defaults on a loan, however, the payday loan companies report this to credit agencies, which decreases a borrower's credit score. Payday loans lure desperate people into their agreements by offering them a financial trap disguised as a lifeline. Those were the 5 biggest financial traps in Black America. Which one do you think is the worst? Which ones did we miss? Leave your opinions in the comment section below, and we'll see you in the next video.